Hello, everyone. Today we're doing a video on Shopify because there's a friend of ours who asked us to actually do an analysis on Shopify. So we thought we could do an analysis because it's a company we've been hearing more and more about, and it'd be interesting for us as well because we can learn more about the company and also share it with the viewers. So we're looking at we're using the four tenets Warren Buffett uses when he analyzes a company. So we thought we just go through the four different tenets because these are the tenets that we use when we evaluate companies. And then we just done some notes. So we're just going to go through the notes and sort of take you through them. So that's it. So Rosh, do you want to start with the business tenets?
Yeah, sure. So business tenets is we want to know who are Shopify, what do they do? So based on our research, Shopify are a Canadian e-commerce company. They offer various services such as online payments, client search tools, I believe, and website platform building, and probably so much more. Their customers are clients and merchants. So anyone who has a product or a service or some sort of offering that they want to sell, those would be Shopify's clients. They make their money in two ways. So one is through their subscriptions, and then the second would be through their merchant solutions. So this would be the online payments.
But they do different. They do online payments, but they sort of, well, one is the subscriptions, and then on top of that you have other stuff. So they can lend you money. They can take care of your inventory and all that sort of stuff. So that's like the merchant solution on top of it. So they're trying to do like everything. You can go one place.
Right. So, and for the next bit around the businesses, we want to know whether the businesses had consistent financials. And in short, no, they haven't. When you look at the numbers year on year, they appear to be losing money consistently. One of the main things you look at is their operating profit. And almost every year up until 2020, it's been negative. And then suddenly at Q2 2020, their operating profit is starting to become positive, as you can see there with those. I believe Q2 would be that second to last bar in that chart there. Is that right?
I'll pull it up here actually because we're here on the website. It's just a bit easier. So Shopify, we're on the website called Ticker, operating income. I need to remove this camera thing. So yeah, we can see that's that's the operating income. Yeah, operating income on a yearly basis, annual basis. It only goes to 2019, so it doesn't capture the last 12 months here. But yeah,
you will see. But then if you scroll down just a little bit further then to that table, we can at least show our viewers there where you've got the blue line highlighted. The last 12 months rather, you can see there's the first positive operating income for end of this year.
I can go to if I go to the quarterly, I think you see better what the thing I show that we, there you can see it. The last two, that's the picture, the last two quarters, they're making money. That's like the first time since 2004.
So, I mean, it's quite impressive, but in short, it's not consistent.
So it's not really impressive because they're losing money.
Okay. Well, I was trying to say the last 2 quarters they have been. We know that.
Yeah, I mean, during COVID, definitely, it's definitely grown. Like suddenly, it's just gone into the green, so that's a positive. Yeah.
Yeah. So the point is that it's not consistently doing well.
Yeah, that's true.
So considering the long-term prospects, they would be one of the bigger market leaders in a growing industry. There's always the need for an online presence has been increasing over the years, and we think it's also been kickstarted by COVID as well, with lots of storefronts closing. There's been a bigger need for an online presence, and even without COVID, just in general, online businesses are growing increasingly. Entrepreneurs, if they're going to start a new business, they're more likely to need a presence online too. And businesses like Shopify are helping small and medium entrepreneurs kick off their businesses online. Yeah, is there anything further to add to that?
No, I don't think so. It's just, yeah, it's a good business. I mean, kind of good in the sense that it's a well-known brand in a growing industry. So that's kind of, in terms of the long-term prospects, it's quite positive, yeah.
Yeah. So I'll let you take over on the management tenets unless there's anything further.
No, so yeah, that's the second tenet is the management tenets. And what we're looking at here is that we want to invest in companies that have good management. And kind of the guy who's the CEO, Tobias Lutke, he's a German, but I think he's now a German Canadian. But he founded it in 2004, Shopify, and he was the chief technology officer until 2008, and then he's been the CEO since 2008. So he's been there from the beginning. So the fact that he's still there is a good sign because he knows the business. And the COO has been there for 10 years, and the CFO has a lot of experience in other CFO positions. So I would say the management team is good. And also, you know, what's good about it, if we go back to Ticker and we look at kind of what's interesting is to see how the revenue is grown. So to be, actually, let's do quarterly. So to see from, So if you see here going from about 24 million in 2012 to almost 1.6 billion in 2019. And then we look at the last 12 months equals about 2.5 billion. So that's a huge increase. So the fact that they've actually been able to do that is very impressive. So notwithstanding that, the fact that they're losing money, the fact that they're just able to grow this business in this fashion is I must say, is very impressive. So that's kind of the good part about management. But the other thing coming to this, to the financials is that, you know, they've been running the business for 16 years now, and they've just been able to turn a profit. I mean, we like to invest in companies that are profitable, and the fact that it takes that long is a bit worrying. I mean, I actually looked at Amazon, and I looked at the numbers back to 2004, and in 2004, which was 10 years after they were founded in 1994, they were making money at that point. So, Amazon, which is kind of, I mean, guess slightly comparable, was already making money 10 years in. So the fact that they haven't for 16 years is a bit worrying to us. And I also looked at in stock-based compensation, they're paying themselves a lot in stock-based compensation, meaning that they get options. Instead of a cash salary, they get stock options. And the way options work is that if you get it's an option to buy a stock. So if you have an option to buy stock at $10, if that stock is worth 100, then that stock option is valuable. So they're paying themselves a lot in stock-based compensation, actually 10% of revenues in 2019. And just for comparison, I looked at Amazon and they were doing 2.4%. So that's a big number. And also what I didn't like is that, I lost Roshni. Roshni, are you there?
Yeah, I'm there.
I think I lost your video.
No, I thought I lost you. I'm back.
Let me see. Oh, there. Yeah. And anyway, what another thing I want to say is that they in their quarterly report, the last one, they said, we made this much money this quarter, but if you don't take into account this stock-based compensation, we made way much more money. And that's kind of when a company is saying like, ignore this thing. If you ignore this thing, we made way much more money. But it's like, well, it's still salary. You're paying it in stock options. So to say that, to give adjusted earnings where they're not counting stock-based compensation, I just don't like that when they say, we paid ourselves 10% of revenues in stock-based compensation, but just kind of ignore that. I don't like it when management does that, and that's something Warren Buffett has pointed out a lot of times. Like, stock-based compensation is an expense, and in this case, it's a huge expense. And when they're saying that it's when they're giving us adjusted earnings and saying that they're removing stock-based compensation, it just doesn't sit well with me. But that's just a small point I had, basically. But kind of in summary on the management tenets, I would say it's good management. They've done impressive things, but there's just certain things that I'm a bit uncomfortable with. So that's it. So
bit of a flag.
Yeah, a bit of a flag. I would say that, I'm not saying that they're dishonest or anything. Like, they're very capable people, but just the way we invest, it's a red flag for us. So anyway, that's it for management tenets for me. So if you want to kind of go on the financial tenets,
Yep.
yeah.
So looking at the financial tenets, we looked at the return on equity and the free cash flow, and beginning with return on equity, straight from 2012, as you can see onwards here, negative, negative, negative. And that's not particularly something that we look for when we want to invest in a business. Although in saying that, for the last 12 months, you can see it suddenly got, Shopify suddenly has a positive return on equity. And then looking at the free cash flow, if you'd like to just scroll down a little bit further.
Yeah, here, yeah, per share. Yeah.
We're seeing quite a similar story again. Shopify is not generating much in cash per share year on year, and again, when it does, for the last 2 years, it's quite small. So again, in short, not consistently positive, not what we look for. And then we started to look at the debt. And we like to, looking at the debt versus equity, the leverage is quite good. So we're seeing 13% debt versus total assets. And having a quick read into this, this was mainly because they've been issuing a lot more equity, and feel free to add a little bit more to this, but I believe they were issuing equity at a much higher price, which is just inflating, the overall equity value, right? And does that impact the debt?
Yeah, so it's the fact that they need more funding. By the way, I just see my camera went out, so I'll try to fix that later. But anyway, they need more funding, and instead of doing it via debt, they're doing it via equity. So they're issuing a lot of equity, and that's why they don't need debt, because they're getting it through issuing equity and getting money through that. So it's kind of like from the standpoint of, it's kind of interesting, because from the standpoint of an investor, if you're an earlier investor, you're being diluted. You had a certain percentage of the company, and the more equity they issue, the more you're being diluted. However, they seem to be issuing equity at a much higher level. So let's say if you bought shares at $10, and then they're issuing equity at $100, and then at $1,000, like they're getting a lot of money in that way. So it's a bit of a tricky one. Like dilution is usually not good, but then on the other hand, like people are putting in a lot of money into the company, and there's more equity in the company, and then you own a share of that equity, so you kind of get a share of the money that the people are putting in at the moment. But then further down the line, you have a smaller percentage of the company, so you get a smaller percentage of the future cash flows. But generally it's just kind of debt. I would say debt is low because they're issuing a lot of equity, and generally I don't like to see companies that issue too much equity, because then you never know how much more equity they're going to issue in the future, and you don't know how much more you're going to be diluted. So if you can look at, I can see here, that's the shares outstanding, this picture. So it's basically going from about 36 in 2012 to I think that's 113. I think it's up to 120 now, the latest number. So that's a big increase.
Yeah, and of course, if for anyone who'd be planning to become an investor, that's not something we want to see. No one wants to see the value of their holdings be diluted, right?
Yeah, exactly. And when you kind of don't know how much more they will do that in the future if they would just sort of issue more equity. I mean, we had that, you know, with Arista, they just issued shitloads of equity, and then you kind of screwed as an owner. But anyway, I'm trying to get my camera back here.
Scroll down a bit further, see what else we have.
Yeah, so that was it for the management. So sorry for the financial tenets. Now we're at the value tenets, and I mean, this one was a bit of a tricky one because we value businesses based on the past financials. So, you know, we value it based on operating income, based on free cash flow, that sort of stuff. But for Shopify, it's all negative until recently. So it's just sort of, it was very difficult to do this valuation. And if I'd seen this sort of, if I was just doing this valuation or doing this analysis on my own and not really preparing a video on it, I would have just said, I don't know how to value this. I'm just gonna let it go. But just for the sake of this video, I decided to have a crack at it. And, you know, as it says here, I came to a valuation of around 1,400 to 1,600 per share. But just, that was kind of me being very generous with the numbers, to put it lightly. Like I predicted,
aren't they?
Sorry?
They're quite optimistic, aren't they?
Yeah, exactly. So I predicted a 50% growth rate in revenues for the next 10 years, because the latest year to year was from 2019 to the last 12 months was 50%. So 50% next 10 years, and then 20% for each year after that. And then terminal growth rate of 2%, but that's not that important after 20 years of that growth. And then sort of, I applied also the margins that they had recently, because they just turned a profit. So I looked at the operating income to revenues, and then I looked at the free cash flow to revenues, and just sort of assumed if operating income and free cash flow is the same percentage of revenues as they were in the last quarter where they finally made a profit, and then sort of predict that forward with those huge growth rates, then I could find a value of 1,400 to 1,600. But again, that's depending on huge growth over the next 20 years, which they might achieve. And then, but it's also based on if they will actually be able to keep their costs in check, because they have, you know, the costs have been quite high, which is why they've been making a loss consistently. So I think kind of the conclusion for me is that I'm so uncertain about this valuation. Like I can't say for sure that this is going to come to fruition at all. So kind of I would say that I'm not comfortable investing in this company, because I don't know if this valuation is legitimate at all. There's just kind of they would have to fulfill a lot of different sort of things for this to be valued at that price.
Absolutely. And yeah, I think you basically covered it all. If there's a lot of assumptions, a lot of what ifs, and
exactly.
Literally just based off the last 1 or 2 years of positive numbers. I think if we're using the actual historical margins, then it would just essentially be a negative valuation.
Exactly. So I actually included this thing here, which is I'll do it on Ticker, but I compared again to Amazon, and I looked at so I went to valuation, and then I looked at enterprise value to revenues. If you compare that to, because I'm in my mind, I've always thought about Amazon being quite highly kind of priced, but if you actually look at, let me remove this. I just gotta move my camera thing. So if you look at this, like the price to or enterprise value to revenue for Amazon hasn't been that high. It's like between 1 and 2. But then if you look at it, Shopify, which is the blue line, Amazon is a black line, then you can see that it's just way higher for Shopify. And you can see here that now it's like almost 36 for Shopify versus only not even 4 for Amazon. What this means is that you look at the price of the company versus how much revenues they have, and that's kind of just a simple ratio you can look at to get a sense of a valuation. Now, it's just interesting if you compare Shopify to Amazon, and Amazon being sort of one of the most famous companies in the world, and one of the most highly valued, and might be like the second highest valued, the third in the world, and sort of a very solid business. And you can see how much that gets sold for compared to revenues versus Shopify. Like, these numbers are quite high. So a high number isn't good in this point, or in this graph. You want as low number as possible. So that was just like an extra added thing I would want to just highlight. You want to do the conclusion?
Of course. So in short, based on the financials, management, and everything else there, Shopify is a good business. It's good at what it does, has a very strong brand, one of the leaders in the market. However, its financials are not consistent enough. And, this is based on operating margins, free cash flows, and then just based on the valuation seen just now with very optimistic assumptions, we're only getting a valuation of around about 1,400 to 1,600, when the current price right now is around about 1,000. Is that right?
Yeah, I think the last time I checked, or just yesterday or the day before.
So with the valuation, there's a lot of, we're assuming it's going to continue growing as amazingly as it's been growing in the last 12 months. So based on that, same as Lars, I agree. I don't think it's wouldn't really rely on that valuation and those assumptions too much. But suppose the price were to drop over the next few years, and suppose it can continue to generate a longer history of these positive margins and free cash flows and so on, then of course, knowing that it's a good business would certainly take another look rather, and decide whether to invest then.
That's kind of that sums it up. Yeah, good business, but given how we look at businesses, it's not for us at the moment. But I wouldn't say that it's a bad investment, or it's just kind of not for us. But yes, sometime down the line.
Yeah, I think that concludes it.
Yeah, that's it, right? There's nothing we missed or anything like that, I think.
No, not really.
Just thanks to everyone for watching, and let us know what you think, or feedback, or anything, maybe any companies they wanted to look at or want us to look at or something like that.
Yeah, I mean, this is quite a fun company for us to look at. Quite a popular business. So yeah, I mean, if there's any requests, do you want to direct our viewers where they should go to find our contact?
Yeah, just go to our website, hpvalueinvesting.com, and just contact details down here. So yeah, that's it.
Lovely.
All right, thanks everyone for watching.
Yep, until next time, goodbye.
Bye.